In our previous tax loss selling video, we took a pretty deep dive into how to engage in tax loss selling in your non-registered accounts. To review, tax loss selling means selling an existing ETF at a loss and then repurchasing a similar but not identical holding to maintain similar asset class exposure in your portfolio. Again, the new ETF must not be deemed identical to the one you just sold, or you'll violate the CRA's superficial loss rules. If you do, you'll lose the tax savings you're hoping to gain. In the opinion of CRA, let's face it, when it comes to tax rules, theirs is the only opinion that matters. Two index ETFs are considered identical property if they track the same benchmark. So if you sell an ETF to harvest a loss, your goal should be to find a replacement that tracks a different index, but can still be expected to deliver very similar performance. I'm Justin Bender, Portfolio Manager at PWL Capital. In this episode of the Canadian Portfolio Manager, I'll suggest ETF pairs that I believe would be good tax loss selling candidates for the equity ETFs found in my model portfolios. Fortunately, due to the seemingly endless supply of new ETFs being launched, tax loss selling for Canadians has never been easier. For this discussion, I'll stick with the most broadly diversified asset class ETFs for Canadian, US, international, and emerging market stocks. And for each of these asset classes, I'll suggest a replacement ETF that will provide similar market exposure without being deemed identical property. As always, you should speak with your accountant or other tax planning specialist before engaging in any tax strategy. Let's start off by pairing up our Canadian equity ETFs. If you're currently holding the Vanguard FTSE Canada All Cap Index ETF with ticker symbol VCN, a suitable tax loss selling alternative is the iShares Core S&P TSX Capped Composite Index ETF with ticker symbol XIC. Both funds track the broad Canadian equity market with a lot of overlap in their holdings, but their benchmark indexes are not identical. VCN follows the FTSE Canada All Cap Domestic Index, which includes about 180 large, mid, and small cap Canadian companies. XIC follows the S&P TSX Capped Composite Index, which is made up of more than 220 stocks. Although XIC includes about 40 stocks you won't find in VCN, these companies have very little weight in the index, so they won't have a dramatic effect on the performance of the fund. Indeed, over the 10 years ending in 2019, these two indexes had a monthly tracking error of just 0.096%. By way of comparison, the 10-year tracking error of VCN's index and the FTSE Canada High Dividend Yield Index, the index tracked by Vanguard's Canadian Dividend ETF VDY, is much higher, at 1.48%, indicating that VDY would be a less suitable tax loss selling replacement for VCN relative to XIC. It's worth mentioning that, as the word capped in its name suggests, the S&P TSX Capped Composite Index places a limit of 10% on the weight of any individual stock. This rule is designed to prevent the index from being dragged down by the collapse of a single enormous company, which happened with Nortel in the early 2000s. If a Canadian company were to one day become larger than 10% of the market, we might see significantly higher tracking error between the two indexes. The S&P TSX Cap Composite would cap the security at 10%, but the FTSE index would continue to allow the stock's weight to grow beyond that limit. If you're considering a switch from VCN to XIC to realize a capital loss, there's little reason to switch back to VCN after 30 days, unless another tax loss selling opportunity presents itself following after the required holding period. As we've seen, both ETFs are expected to have similar returns going forward. And without knowing which ETF will slightly outperform over your investment horizon, I'd recommend just holding on to the replacement ETF, saving yourself the extra cost and hassle of switching back to the original. If you've decided on the iShares Core S&P US Total Market Index ETF with ticker symbol XUU for your US equity exposure, I recommend the Vanguard US Total Market Index ETF with ticker symbol VUN as the most suitable tax loss selling replacement, and vice versa. XUU follows the S&P Total Market Index, which tracks the performance of over 3,500 large, mid, small, and microcap companies, making it one of the most diversified US equity indexes. VUN follows an equally comprehensive index, the CRSP US Total Market Index, which also includes around 3,500 large, mid, small, and microcap companies. From 2010 to 2019, the underlying indexes had a monthly tracking error of 0.041%. As with our last example, their past performance has also been nearly identical. Suitable tax loss selling pairs for international equity ETFs are harder to come by. You might consider the iShares Core MSCI EFI IMI Index ETF, with ticker symbol XEF, and the Vanguard FTSE Developed All Cap X North America Index ETF, with ticker symbol VIU, to pair perfectly with one another, as they both track over 3,000 large, mid, and small cap companies in developed countries outside of North America. However, index providers FTSE and MSCI differ in which countries they consider to be developed. The most obvious example is South Korea, which is classified as a developed market by FTSE, but as an emerging market by MSCI. As VIU follows a FTSE index, it allocates more than 5% to Korea, while XEF, which follows an MSCI index, has no Korean companies at all. This difference has led to a higher monthly index tracking error than our previous tax loss selling pairs, at 0.223%. The same country classification issue arises with emerging markets indexes as well. At first glance, the iShares Core MSCI Emerging Markets IMI Index ETF, with ticker symbol XEC, and the Vanguard FTSE Emerging Markets All Cap Index ETF, with ticker symbol VEE, seem like perfect pairs. Both underlying indexes follow thousands of large, mid, and small cap companies in developing markets across the globe. However, since XEC follows an MSCI index, which considers South Korea to be an emerging market, it allocates more than 12% to Korea. On the other hand, VEE, which follows a FTSE index, considers South Korea to be a developed country, so you won't find any Korean companies in this ETF. This difference has led to a relatively high monthly index tracking error from 2010 to 2019 of 0.555%. Now, I'm the first to admit, these tax loss selling pairs for international and emerging markets equity ETFs are not perfect. If MSCI upgraded South Korea to developed market status, we wouldn't have this problem. We could switch XEF to VIU or XEC to VEE, knowing that the future performance of our replacement fund would likely closely track our original ETF. But until that happens, it would appear we're stuck with these next best tax loss selling pairs for international and emerging markets ETFs. Thanks again for watching. I'm Justin Bender of PWL Capital, and this is the Canadian Portfolio Manager YouTube channel. If you enjoyed this video, please feel free to also check out the Canadian Portfolio Manager podcast and the Canadian Portfolio Manager blog for more useful investing tips.